What we know is a drop. What we don't know is the ocean.
Hello and welcome to the Newton Knowledge Podcast. My name is Mark Singer, partner of Newton One Advisors, and I'm joined by our managing partner, Steve Target. Steve, how are we today?
Mark, thanks for asking. I'm doing very well.
The Newton Knowledge Podcast will provide meaningful content to our valued advisor community and anyone who is interested in learning more about sophisticated insurance-related topics focused on estate planning and executive benefits. Our discussions will deliver unique insights into the people, processes, and products that make our industry so critical. Newton One is a national life insurance planning firm delivering customized solutions structured to help clients and their advisors engaged in solving estate planning, wealth transfer, business succession, and executive benefits challenges. We are a member of the M Financial Group, which grants our clients access to the nation's elite carriers and exclusive products available only through our network. We're joined today by David Neufeld, a lawyer with Flaster Greenberg, a terrific multi-practice, 75 lawyers in total with offices in Philly as well as along the East Coast. David heads up his Boca Raton, Florida office and has many years practicing in New Jersey as well as New York and Pennsylvania. David is a tax and estate lawyer known nationwide as amongst the best. Today we will be looking at how taxes are affected by where you live. Our main focus will be on where one lives in the U.S. and state tax consequences. David, does leaving the U.S. free someone of paying U.S. tax? And is that what happened with this particular celebrity case with Tina Turner's situation?
Gentlemen, thank you for having me on. It's interesting. Where you live, it does actually impact on the taxes you pay, clearly, and that's whether you move from the United States outside the United States or you move within the States. So in this case, we have a situation which seems like it might be sort of a classic case of leaving the United States for tax benefits. I'm not so sure that Tina Turner actually was that situation. But regardless of what she did or why she did it, it does bring to the conversation why people do things like this. Otherwise, generally, the thinking is that if I leave the United States, I no longer have to pay U.S. income tax or maybe estate tax. So that may be the case, but not really typically. All right. First of all, when we say leaving the United States, what we really mean is giving up your citizenship. Right. Not a lot of people, it's not just moving. Not a lot of people really want to give up the U.S. citizenship. But if it's worth it enough, and there are plenty of people who are making $1 billion on a sale of a business, think it might be worth it, might try and do something like that. However, it doesn't quite work the way we would like to see it work. First of all, if you under the current state of law, if you give up your citizenship, you actually have to accelerate the gains on all of your property and pay tax as if you had sold everything. So right off the bat, regardless of what you might accomplish after you leave this country, it's going to cost you a lot of money. Even if you're out of the country and you've relinquished your U.S. citizenship and you have family back in the United States and you give them you die and you give them a bequest or you give them a gift, there's going to be still estate tax or gift tax effectively paid on that transfer. So it doesn't, on the face of it, doesn't really do what the folk law would indicate. However, having said that, every law has its exceptions and has its gaps. And there are certainly ways of relinquishing either U.S. citizenship or your green card if you're here for long enough, and not necessarily bearing the full brunt of those taxes, or by making gifts to family members without necessarily bearing the brunt of that tax. Having said that, it's way, way, way too deep in the weeds to go into the hows and whys. Just suffice it to say that for the most part, there's a substantial cost to it, tax cost. And if you're situated in the right position and you're working with the right counsel, you might figure out a way of saving some of that. So Tina Turner, maybe her family did great out of all this. I can't say particularly, but her situation is probably not illustrative of things that everyone can do.
So I have a follow-up question to that. We're actually working on a case right now with a family that's considering moving to Italy and for estate tax purposes. They are well above the exemption. If I understand what you're saying correctly, the taxes are still going to be paid if they relinquish citizenship to Italy. But if they still have assets in the U.S. or if most of their assets are in U.S. dollars, is there ways they can, I guess, minimize or mitigate the taxes, or their goal being to eliminate some of the estate tax by moving to Italy? Is that a fair assessment?
There are almost always planning opportunities, sometimes greater, sometimes lesser. Often planning opportunities that we can accomplish, or we can grab onto. Not knowing anything about this case, obviously, I can't say whether they have or they have not. They have access to these opportunities, but one of the estate tax issues over here is it's actually referred to as an inheritance tax because of who pays the tax. But the trigger on a gift or bequest, if it goes to a U.S. citizen, so if this family moves out, and if every one of their family members relinquish their citizenship, maybe there's an opportunity there to do some tax planning.
Their children would have to move as well then, the entire family.
That's right. As long as it's going to a U.S. citizen, if the money comes back to a U.S. citizen, the U.S. citizen pays the tax.
Well, David, let's pull this back to the United States now. And as we all have clients that it seems to me like even over the last 3 years, we're seeing more folks that are living in the Northeast, maybe they're Pennsylvania, Jersey, New York, that are looking to buy homes in Florida. Might be the weather, it might be other reasons. Maybe it's the taxes in Florida, maybe it's the estate taxes, income tax and estate tax. But is it that simple that you can just move your residence or have a residence in, for example, Florida and eliminate some taxes? To kind of walk us through some of the challenges and also opportunities.
I will say, look, I'm in Florida, and the weather is an attractive element. I remember when I moved myself down from the Northeast, I was very pleased to get rid of my snowblower. I will tell you that taxes seem to be a much bigger motivator for a lot of people. And yes, the answer is you can change your residence, and you can free yourself of state income tax and state estate tax if that's a factor. But it's not exactly as easy as people seem to think of it. I think it is. I can't tell you how many people I have a conversation with that say something like, well, I'm out of, name the state, New York, New Jersey, Pennsylvania. I'm out of that state for more than 183 days, so I don't pay any tax. I am a resident of Florida. And my answer to them is, well, I'm sorry to tell you, you're wrong. That's not all it takes. And I will tell you that and then I get resistance to that. Of course it is. My friend doesn't pay tax. He did this. Well, if all it was because my friend did something well, I should buy the same lottery ticket numbers he got when he won this lottery.
Of course.
So, no, it's not as simple as that. The problem is. And in fact, inevitably the conversation comes down to, look, I could help you structure yourself right if you want, or if you prefer to just wait, I can help you find an audit at about 10 times the cost. So the real problem is that people don't understand the rule. Okay, there's a rule on that says that if I am, and by the way, we're focusing on people to make it easy for this conversation that have a home or some what we call a permanent place of abode, but call it a house for argument's sake, in both the northern state and Florida. Okay, there's nuances here. We're not going to get involved in. It is entirely possible that, and let's take someone in New Jersey, that Mr. X spends 2 months of the year in New Jersey and 10 months in Florida, and it's entirely possible he has to pay all the tax in New Jersey that New Jersey wants, all the income tax, all the estate tax, if it ever comes down to that. Oh, I'm sorry, no estate tax, but if there's an inheritance tax potentially in New Jersey. In New York, there isn't an estate tax. So it's entirely possible that it doesn't matter that they're out for 183 days. The reason is the rule, the 183-day rule says, most people have it backwards. It doesn't say if I'm out 183 days, I'm free. What it says is if I'm in the northern state for 183 days or more, then I lose, right? But it doesn't, the corollary isn't that I win if I'm out. Okay, so that's the problem. Most people don't understand that. And it comes, when we do this analysis, it comes down to, and frankly, when the auditors do this analysis, we're not making the rules. What we do is we do these contrived audits, if you will. Right? We look at someone's situation the way an auditor would look at it, and determine whether they should be subject to tax. The first thing to look at is what's called domicile. Right? Domicile is where in the cases it sort of says the place you return to from when you're away. I like to look at it as if everything went to hell in your life, and all you had is 2 houses, where would you live? Where would you go back to? Would it be the place where you're up north, where your family, your kids are, your grandchildren are? Would it be the place in Florida for whatever reason? That's sort of how it's defined. But these are domicile is sort of a you have to read someone's mind. What do they intend? Where do they intend to be living? And you can't really make determinations on things like that. So what they look at is they look at factors, right, to read your mind. And they say things like, where is your family? I mean, do you have little kids in school? I mean, are you trying to tell me that you've got, a 4th grader up in New York in school and you're living in Florida? And I'm not talking about, Groton, public school. So they look at things like where did you move all of your important personal effects? The family photo albums. I had a client who had a multi-million-dollar antique auto collection up in New Jersey, and wanted to keep it up there with the house up there instead of, for some reason, not move it down to the new house in Naples. Well, first of all, why keep a multi-million-dollar auto collection in snow and salt? But besides that, my answer to them was, no matter whatever else we do with this planning, if you leave that collection up there, you're going to lose your case, because that's important to you. Right? These are the important things. Where you want to see the things you love to see. So there are all sorts of, there's 5 basic factors that they look at. They also look at these other things. Where did you get do you have a driver's license someplace? Library card, where do you vote? But frankly, those elements, everybody thinks that's really important, right? 183 days and I have a driver's license. Not that big a deal. Okay, if you don't do it, you lose, because those are just too easy, right? You have to do it. If you don't do it, you lose. But that you do it doesn't matter that much. Okay, it's an interesting little dichotomy there. So what they're really looking at is sort of this nuanced way of crafting your life. What's really important in your life, and what draws you to a home. What is a home? Right? That is what they're looking for.
How does this typically work? Is it the estate tax is filed and the burden of proof then is on the estate? They say, hey, our residence is Florida, but then there are other residences in New York, and New York comes back and says, well, prove it to us. Or Florida says, prove it to us. Is that typically how it rolls out?
So for the most part, Florida doesn't care. Okay, now that's not entirely true, right? In Florida, we have the whole concept of homestead and things, and you have to have your primary residence down here for it to be your homestead. So Florida does more or less care, but they're not gonna, if you more or less have sort of touch the right bases, you can establish homestead down here fairly easily. Well, the state that cares is the state that's losing the money, right? There's no income tax in Florida, right? That's the whole point. There's no estate tax in Florida. So the burden of proof is on the party who's saying that residence has changed. So if I'm moving from the north to the south, and I'm saying that now I am going to be a resident of Florida, if I get audited by the former state, it's my burden of proof. It's my burden to prove that I've moved. But by the way, let me just say that the domicile, I described domicile moments ago, right? If I am successful in proving that my domicile is Florida, that I've done all these things, I've moved all the things that are important to me, I've proven that this is my home in Florida, I could still be taxed in New Jersey or New York, and up these other states. And that's where the 183-80 rule comes in, right? It says, even if I'm a domicile someplace, if I have a permanent place of abode, if I have a house up in, call it New Jersey, I am in New Jersey for more than 183 days, then even though I'm a domicile, I will still pay income tax to New Jersey as a New Jersey resident.
Domicile seems pretty objective.
Well, that's the whole point. Now they look at all of these criteria, right? They look at these these concrete criteria to try and come up with this amorphous concept. But that's not unusual in the law. We're always looking for intent, and we're always looking to figure out what indicates intent if we can't just trust you to tell us, right? So
I'm sure this happens a ton. If someone wants to keep ties in the Northeast, how do they legally avoid being subject to taxes in those states if they also reside in Florida?
So having ties is not a problem. Plenty of people have ties, and there's nothing wrong with having ties. It's the magnitude of the ties.
So what magnitude of ties should one be wary of?
Sometimes people say, look at the value of the two houses you have, right? If I have a 2-bedroom apartment someplace in the middle of New Jersey, as opposed to a mansion in Florida, you could say, look, it's a convenience, right? Or if I have even a vacation home on the shore, people understand. People do things for vacation. That's not a tie that's necessarily going to trigger tax, right? But you can't always do that. I have a $7 million condo in New York City that may be very well 700 square feet. That it's so it's not a completely accurate rule. It's interesting. They'll look at things in an audit. They'll look really deep at things. They'll look at your moving receipts, right? And they'll look at your insurance premiums and say, where are the things? Where do you keep all your jewelry? Where do you keep your grandma's Hummels, I like to say? The family photo albums. Did you move down the very valuable piano that you have? Where's things being shared? So they look at these kinds of things. If you don't have these things following you, it's one thing, of course, to say, look, I've got 2 of everything, right? So if you don't have these things following you, that could be an issue. You make an argument. It's a very fact-specific, and therefore the planning for this is very detailed. You don't walk into a lawyer's office one day and say, I'm moving tomorrow. Let's prove I'm not a resident. In the situations where they get complicated and expensive, and there's a lot going on, you want to be clear that you've planned this thing properly, and it takes quite a while sometimes, months and months, to do the proper planning.
One of the, observations from Mark and I, and specifically our firm, is that the activity and the amount of inquiries we get from the community about estate planning with this looming January 2026 deadline that's coming up that could impact many more people. I mean, the estate tax now, or January 26, is certainly going to impact a larger percentage of the population. And so I guess the question is, there's other solutions beyond what we do, which is structuring life insurance policies and having them tucked into a trust and create this wonderful tax-free environment. But there's other solutions, and some of those other solutions involve meeting with you, as you just said, and having enough of a timeline and an advance, deliberate decision-making process about residents and where to live and how to structure this. So I guess maybe our final question, and there may be something else you want to add, but our final question would be, give our audience some advice on maybe when to start thinking about meeting with you, when to start thinking about residents and domiciles and where things are and ties to different states? It's not one day. Is it 3 years? Is it 6 years? And how long does it take to line up the affairs appropriately so that you can prove and you can achieve what you want to achieve?
So that's actually a very insightful question. Every client's different, right? I will say that if there's a common denominator, it's not don't show up a week before. But in some cases, I'd say 4 or 6 months of planning. In some cases, it could be a year or 2 years of planning. It depends on how complicated one's life is, and it also, to some extent, depends on how much we're talking about savings. I'd say the sooner the better. It's never too soon, right? Because we could always say, all right, come back to me in a year. But too late is always too late. So from that point of view, I think you have to come into this with the expectation that this is a serious planning venture, and that we need to be very conscientious about it and not just sort of kiss it off as if I only need to be someplace for 183 days.
Yeah, there's consequences to all the decisions, right? I mean, if you really are changing where you're living, folks need to think through what that means.
That's right, and it's very involved. That's exactly right. And going back to something you mentioned earlier, by the way, I will say that anytime we're talking about a substantial amount of tax, we always understand the value of life insurance, right, to cover that ultimate cost. And life insurance has that unique benefit of covering those taxes. And the concept of residency is not necessarily hand in glove with life insurance, but nothing is necessarily immune to tax. And so from a federal standpoint, which we're never talking about getting away from federal tax when it's talking about state tax residency, what we do know is that today a couple can leave $26 million and have no estate tax. In a couple of years, January 1st, 2026, we're talking about probably somewhere between $12 and $14 million, which opens up a whole mass affluent market to people who are exposed to tax. And those who have poo-pooed the need for life insurance to pay tax in the past are going to find that they have this new need. And I've always been a big fan of the use of a properly structured, properly priced life insurance policy to solve that problem.
We appreciate your time. You provided some very, very good information, very applicable. It's funny. I was just at an event and I was speaking with a business owner, and he said he just moved to Florida for the weather, but also for tax reasons. And I said, well, how do you qualify as a resident, or how do you become an actual Floridian? And he said, you only have to be there 183 days. So after this conversation, that couldn't be more incorrect, huh?
Absolutely. I mean, he may still be doing things right, but I will tell you that that's not the right answer.
Yeah.
And if he or other clients of yours really think that, to make sure they have my card, because they're either going to need it now to make sure they do it right, or they're going to definitely need it later when they get audited. And those, except it'll just, as I said before, it's probably about 10 times the cost.
Well, I'm sure he'll listen to the podcast.
So anyway, yeah, it's actually quite sad when I feel bad for a lot of these people, because they really do believe this, and they listen to the guy in the in their country club that just got it all backwards. So.
Well, David, that's all we have for today. Is there anything else you want to add?
No, I just thank you very much for having me, and it's always a pleasure to speak with you guys. You're at the top of your game, and I always like dealing with people at the top of their game.
Thank you. The feeling's very mutual. Thank you, David, for your time. David Neufeld.
Absolutely.
The material and opinions voiced are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what is appropriate for you, please contact a member of our team.